attention, because the strategies you learn are not the types of things that you want to pull out after you become the high net worth guy. You want to start planning them right now so that you can implement them at the beginning of the year, not at the end of the year when the tax man says, "Oh, you're too late. You didn't do what you're supposed to do." Okay, so I'm looking forward to tonight. Now, for a little bit of housekeeping, let's go to the next slide there, if you would. One of the things is, how did everybody find out about tonight? Facebook, Meetup, Facebook. Somebody else, right? How many first timers do we have here tonight? Okay, that's a good number. Thanks for coming. And you are Andrew's daughter, is that right? Where's Andrew? I was hoping to talk to him tonight. Okay, because I need to get I'll chat with you afterwards. Because I'd like to get Andrew to come talk about what he's been doing lately. I think that's going to be a good session. Yeah, I'm talking about some apartments and commercial ventures. All right, so we've gone through the introductions. The next piece is brags and deals. Anybody got a deal that they just bought? Got a good deal that's going on? What you got, Chase?
So I mentioned my flip I'm doing because that's where all my cash is right now. But I'm wholesaling a subject to deal in Hampton on Calvary Terrace. Actually not far from where Allen Iverson grew up, oddly enough. Someone told me that. Total entry fee is going to be about like $28K. Mortgage has 17 years remaining, so you're almost halfway done with the mortgage, so a little bit better principal pay down there. It's a 1.5, a little over 1,500 square feet. It's brick. So mortgage balance. Vacant. Mortgage balance is 116. 28 is needed on top of that. Some of which will go to the seller, some of which will go to me, some of which will catch up.
Okay, and what kind of repairs we need on that?
I've been hearing between 40 and 60K.
40 and 60. Okay. Have you got a flyer?
I've got an email.
Got an email. All right.
At the end of the meeting, if anyone's interested, me your email. I'll start the email. I'll BCC and just forward it out.
All right.
I have a question about that.
Yes.
I know that because I'm a realtor, so you listed around $170,000. It's 169 now, so 170.
Yeah, we initially listed as a cash deal, and I went back to the seller and we flipped it to subject.
When you say flip, what is subject of? Like I'm an investor, so I like to buy good companies. So what is you get 170, and then the ARV is how much is ARV?
About 250.
Okay, 250. So what's $8,000 left over, right?
Yeah, but now it's a lot less. Now your total price with sub 2 and the cash up front, it's like 146.
I don't understand.
I tell you what, you two get together, and when you get a little bit of time, you can talk about it during the networking. Yeah, it's getting down into a little more into the weeds. Yes, sir.
My deal is a little different. All right.
What you got?
For myself, number one, under the, like I said, the military events, so that's 10% off the price of whatever you acquire from my services. If you're a senior citizen, that's 5% off for you, right? But the main thing is, I don't know if you guys know too much about ASHI and INACHI, right? When it comes to the organizations I'm with, I represent. But mainly, if I do an inspection, or my company does an inspection on one of your properties, and we miss anything as part of our standards we have, they'll buy back your house for the amount that you paid for. So take a look at that to be another assurance to where I'm coming in to do a pretty good job on that part. So just take that from me.
Yeah, that's a pretty good. That's a good deal. Where are your two deals? You said you had a couple.
They're my turnkey. They're both in Suffolk. My in progress are in Suffolk and Portsmouth.
Okay. There was another question back there. Yes, ma'am. Oh, okay. You're good? All right. Okay. Next slide. What do we got? Oh, okay. Go ahead.
passing the word along. If anyone knows anyone who wants to move to Grandview Island, if you either know about it or you don't, it's a very like little exclusive little area out there, and we're in a position to offer it around the 700,000 mark, and it's 5,500 square feet, so it's a massive house. It's got like a row view type design, so it can have an elevator, it can have a chair lift. It's got 6 bedrooms and 6 bathrooms, and it's an amazing house. So if you guys know anyone, ideally off market would be great. We can keep the price lower. If it's with realtors, it's going to be a higher price. But the last comp that was half the size sold for $745. So we're offering $700 if we do it off market. So if anyone has anyone that wants a big, behemoth, beautiful house.
Where's Grandview Island?
If you take Mercury all the way down to Buffalo Beach Drive, you take it all the way out, kind of up above Buffalo.
That's a nice area back in there. Yeah, I like it. Okay. Yes, sir, Mr. Vincent.
Do we have any lenders in the house? The lenders?
Lenders, private lenders or bank lenders?
Bank lenders.
Yeah, we got 2.
Right here.
I work, the lender that I work with, got a program for investors, low income, but you have the cash, you can purchase property.
Yep, I have that.
You got that? Okay. All right, so that's lenders already familiar with that. I think that's awesome way to acquire property. You have cash. And not, income is a problem.
Right.
20% down, 680 credit score, investment property. They don't, you're not, they're not looking at your income or your, anything else. They're basing it on the cash flow of the property.
All right. What you got, Chase?
I have another deal I forgot about.
Uh-oh, you forgot about it. You got so many you're forgetting about them. All right, let's make this quick because we do want to get to our talk tonight.
Another wholesale deal, Townhouse Newport News. I forget the complex. It's kind of like a smaller courthouse green, smaller complex. 89.9, pretty close to turnkey. I mean, some of the laminate floors are, looking like
89.9. What's the rent for?
Hold on, you said courthouse?
No, it
He
looks
said it's like courthouse green, not in courthouse green.
Okay.
I forget the name of the complex, but I mentioned laminate floors. It's like a cosmetic deal as far as doing it. I need to find out what it's renting for. I don't know what the tenants are paying right now. They'll be out on the 21st.
Okay.
What's the size? 3.2? 2.2?
3.2.
3.2. Yeah, can you call me later?
I thought you might.
All right, so let's get into some tax strategies here. How to save some money. We got Dawn and Parker. Parker, you're going to start, right?
Yes, sir.
Come on up. Now, you guys are with Oceanside Financial Strategies. I don't know that much about them, so I'll let you get onto your. You can really tell us about your company.
Okay.
We're here. We're listening. Let's see what you got going. Thank you very much. Oh, yeah, I do need to give you this.
This is
Just clip
microphone?
that. Just clip that to your pocket there. You'll be good. One more thing I could, if you're not a member of the Facebook the Facebook group or the meetup group, I've got some QR codes to help you get into those.
All right. Well, wonderful. Good evening, everyone. My name is Parker Hannis, joined here with my dad, Don Hannis, and we're from Oceanside Financial Strategies. So on the other side of the tunnel, we have about 10 of us in our firm. Offices in Town Center, and then also off Thimble Shoals, so pretty close by to y'all. Our focus is holistic financial planning, but as for tonight, we're going to talk about cutting taxes and protecting assets. The basis for our work to be really comprehensive in the approach, as we'll find out tonight, is we know that you all have worked with your advisors for tax and legal and financial or insurance, but so often we find that when that planning gets done in each individual silo, it's not coordinated. People aren't sitting around the same table talking about your situation, and that's what leads to missed opportunities or things slipping through the cracks. So for tonight, we're going to talk about a few areas. Sean Riley from Hanger Law was going to join us. I think there's something going around the water in Virginia Beach where I think there's a little bit of COVID going on. A lot of that going on. So unfortunately, y'all are stuck with just Dad and me. But we are going to keep an eye on the clock and make sure that we make some good progress. We want to be respectful of y'all's time. So there may be a couple questions. There may be a couple things that we breeze through. We would love to follow up with y'all. We're happy to sit down for an hour for a free consultation and go from there. So let's get into it. While we start with the introductions, I'm going to pass this little thing around, and if anybody guesses what it is, there are 2 right answers. We'll sit down for 2 hours.
2 hours.
For 2 hours. Answer every tax and legal question y'all have. So I'm going to ask what that is in a few minutes. Like I said, guys, Don Hannes, Parker Hannes, we like to tease that between the two of us, there's 37 years of experience, 35. And then we just pause for that. We were really hoping Sean was going to be able to join us tonight, but like I said, I think there's a little bit of COVID going around in Virginia Beach. All right, so first thing before we start getting into estate planning, tax planning, and asset protection, we always tell our clients to hit pause and take a time out. We never make any decisions before we do financial modeling. We are going to talk about some tactics tonight, and they're going to sound great. They're going to save a lot of taxes. But just because it's a great idea doesn't mean that 20 years down the road, we're still going to think it's a great idea. So what that means in plain English is don't give away assets if we're going to run out of liquidity or cash later. And we use that for financial modeling to see what someone's scenario looks like. If we make those changes now, what's going to happen 20 years down the road? And I think that the next slide does show us modeling someone's scenario of green with the income coming in the red. We also use financial modeling to help people accurately track their net worth, your weighted average growth rate of your estate. Some of what we'll talk about tonight probably presently applies to y'all, but especially on January 1st, 2026, when a lot of this kicks in and becomes active, will apply to y'all. So the financial modeling sheds light for down the road of what planning needs to be done now so that later we can be poised to make the right decisions. Some of what we talk about has a 3-year look-back period. So again, more information we have now when we aggregate cash flows and assets, income streams to see what's going to happen in your scenario down the road. Anything else for modeling, or is that it? Yeah. All right. So I hope everyone's getting comfy in their chairs, because this is when everyone's belly's full. We've had a good dinner. This is where we start getting into some of the nuts and bolts. Basic estate planning rules for 2022. Now recognize we are about to go into 2023 where some of this is going to change. There's going to be a lot of change coming up in 2026. But for our first bullet point, you are only taxed on what you own and control. So we're talking about estate taxes when you pass away or you and your spouse pass away. What's a good example of something that gets taxed in someone's estate? House, life insurance, belongings, investments. These are assets that you control and you have the income from them. So those are generally includable in someone's estate. Going to the second bullet point, you are able to gift everything to your spouse without gift tax or estate tax ramifications. Notice that it has to be your spouse. I'm actually married to a girl from Australia, so she's not a U.S. citizen. She's my spouse, but she's not a citizen. So we have very different rules there. So if you're married to a U.S. citizen and it's a legal marriage, you are allowed to leave them an unlimited number without worrying about estate taxes. This next bullet point, I really want Dad to pay attention to. Who's interested in their parents making annual gifts of $16,000 to them every year? Show of hands. Dad, any hands?
My parents are dead.
What was that?
Whose parents are actually to give them the gift of $16,000?
You got another one over there.
You need to adopt another child?
Hey, it could go the other way, right?
Right?
It could, but
It could go up.
Well, you don't need
What
it,
happens
just
now?
any individual. So you,
but we do want to deflate the value of one person's estate and then inflate the value of the others. And this is the crux behind the idea. That you are allowed to give $16,000 gift tax free or estate tax free to any one person during each calendar year. Now, because my parents are so generous and they're together, they could do $32,000.
There you go.
Take it a step farther and include my wife for how much?
She's an Australian though.
Not in a year and a half. So you are able to start making gifts. We do not want to tell you guys to gift away cash, liquidity, and investments.
Is that only parent to child, or?
Anyone.
So, I'm sorry, if I have a property and it's worth $64,000, can I gift it in pieces?
Correct.
Okay.
Correct. That's called carving up assets in gifting out shares, which we'll be talking about later.
Okay.
But we do not want you guys to start gifting assets to the next generation. Again, this is tying back into the financial modeling we just talked about. One, because it's possible that taking action now compromises later. But we do not want what you need to live off of to be gifted to someone else. Cash does not apply here, as much as I do want the cash. In addition to the annual gifts of $16,000 or whatever number you come up with each year, you are allowed to pass about $12 million from one person to the next. And then the excess over that is subject to a 40% estate tax. So if my dad were to pass away tomorrow, say his net worth is $5 million, we don't have a problem here. Say his net worth is $15 million, well, we have $3 million of exposure. At 40%, that's about a $1.2 million tax bill that's owed. Now, because my dad's married, his 12.06 gets doubled into actually what I guess would be 24,120. So currently a married couple can leave $24 million before estate taxes apply. This can be used during lifetime or upon your passing. We're not going to go into too much of those specifics at the current time, but think about what happens to your house over time. You pay off debt, so the asset increases and the asset appreciates. So if we back into the time value of money, perhaps some of our high net worth clients appreciate taking advantage of this exemption now and getting it out of their estate before later. But this exemption can be used during life or death. Here's the kicker. President Trump and Congress put in the TCJA in 2017, and the provisions written there said it's automatically going to sunset unless someone does anything on December 31st, 2025. So instead of having 12 and change, it's going to revert to 6 million per person. So call that 12 million. The estate exemption is going to be cut in half. The excess of that is taxed at 40%, and you only have 9 months to pay that tax. So if you hold assets that are illiquid, meaning not cash, stocks, retirement, life insurance, you're holding property, raw land, that 9-month trigger can be something to discuss. Has the object made it around the room? All right, I know Dave has one of the answers, so I'm not calling on you first. Has anyone thought one of the two possibilities might be? For anyone tuning in online, they can see that. Any thoughts? Good, but not quite. Instrument. It's not an instrument. It has to do with taxes.
Oh. So the three certainties in life, it represents life,
Death.
or death, taxes.
That's good. And I think I'm going to start making that a third answer. Life, death, and taxes would be the three certainties. What about this being a tax loophole? Or what about this being a tax shelter? Okay, all right. Glad we have everyone laughing.
2 hours.
You guys are really going to start falling asleep. Okay, so estate planning. We talked about gifting. We talked about using the exemptions during life or upon your passing. And we talked about how that's going to be cut in half in about 3 years. Some of this planning, I think I already mentioned it, has a 3-year look back period. So even though we're in 2022, we want to start talking about doing some of this before it's game time, January 1st, 2026.
What about step up in basis?
We'll go through step up in basis real quick. If my dad were to pass away and he's fully depreciated in an asset and I receive it, the cost basis of it would be stepped up to fair market value. So I would redepreciate it, or I could sell it with no capital gains tax exposure. Current administration is talking about legislation that would remove a step up in basis, which means I inherited at a very low basis and I cannot redepreciate it, or there'd be a lot of tax if I sold it. More on that later when we talk about charities.
All right.
You want to talk about
Yeah.
Okay. And then I'll come back up to the charity.
Thank you, Parker. So Parker, he's chip off the old block. How about that? But I'm Don. I've been around a long time, and I got my start in financial planning because I was in the pharmaceutical industry, and I realized you can't make a lot of money as a manufacturer's rep. So I started buying no money down real estate in the 80s, had 8 properties up to here in debt, couldn't sleep at night, couldn't take it. So I'm down to 3. But
4. Because it's a duplex.
okay.
There are 2 deeds.
But anyway, I have a lot of respect for you if you can live with the debt and make the numbers work. But in any event, I want to talk to you about 2 groups of people in the world. Savers, spenders. Which group of people tend to come to these tax seminars? Savers, right. Because spenders aren't going to have an estate tax problem. They're going to spend it, run out of money, move in with their kids. But let's say, and I realize some of the numbers here might be too large for our group. There's not, a married couple in here worth 24 million, right? Yeah, isn't always the case. But as Parker said, the tax laws are going to be cut in half, and there are a lot of folks with real estate that married couples have $12 million, and you might be in that group now, or hopefully in the future. It's a problem I hope we all have. It'd be a good problem. But let's say you're high net worth today. You're worth 13 million, and you're not going to die today. You're going to grow, pay down debt. Property's going to appreciate, and you're going to grow at 5%. So in 10 years, your net worth grows to $21 million. Hard to believe, but if you do the planning, if you track your net worth, you'll be amazed at how your net worth compounds. It's that first $1 million that really is the hardest, because after that, it's kind of like a snowball going downhill because of time and compounding. So you'll see that your net worth grows 62%, and that's great news. Everybody wants to be worth more tomorrow than today. But the problem is, and it's hard to see that, but
Are those, did your slide, is that supposed to do that? Are they going to pop out, or is that my projector?
I think that's your projector.
Okay, sorry about that.
But you'll see that if you grow at 62%, the taxes grew from 0 to 3.28 million. Okay, again, great problem to have. I hope we all have this problem. But what we're going to talk to you tonight about is shifting the growth so that the IRS doesn't benefit. We want you to grow. We want you to be high net worth. We just don't want you to let the IRS be the beneficiary of it, especially in light of the new tax laws that are coming in 3 years. Okay. So our number one recommendation, how do you slow the growth of your estate?
Borrow more money.
Well, I would say spend it. Because if you're borrowing money, you're buying an asset, and that asset's going to grow, and your net worth's going to grow faster because you're leveraged, right? So we do have a lot of folks that they're savers. They don't spend. They're always waiting for the rainy day. And when you do the financial modeling, you actually see that, we're doing pretty well. Maybe we can enjoy the fruits of our labor. Maybe we can take the kids to Disney World or buy a boat. Something like that. So our number one recommendation is to really sit back, enjoy your hard work, the fruits of your labor. Our second best strategy would be to make gifts. We've talked about gifts. And the gifts can be outright, or you can set up a trust. A trust. And we'll talk a lot about trust tonight. As Parker said, we don't really want you to give away cash, because you're going to need cash. But you can give away pieces of an LLC. You can give away partial ownership in an entity. Keep your cash. Give away non-liquid assets. We'll talk again more about that. Now, you can give the asset outright, or you can give it in trust. It's the same tax savings. But gifts outright, there's no chance you could ever get it back, unless you have cooperative children, let's say, and they're hard to find.
Very hard to find.
But if you put the
Depends
money in
on
a
the gift.
trust, we can give it what's called a trapdoor provision. Your spouse could be the trustee, and you can share the money, and you have indirect access to the trust. These trusts are irrevocable. So that word is kind of scary, because you're thinking, gee, irrevocable, I don't know if I want to be doing this. Will I regret it in 20 years? Yeah, obviously you don't do things like this unless you do careful modeling. But we'll talk about gifts to a trust, because that way you can be certain it stays, and it could come back to you in the event you needed it. Hopefully you don't need it, but it has a trap door. All right, so this one's called a spousal lifetime access trust. And we have a client that has a big apartment complex down in Suffolk, and net worth of over $15 million. And the concern is the property is really appreciating, and their net worth's going to double in 10 years, and they're going to be faced with huge estate tax problems. So what we're suggesting is that the husband set up a spousal lifetime access trust for his spouse, and the wife also sets up a spousal lifetime access for the husband. Okay? The trusts have to be a little bit different, but they're both irrevocable. So again, think and act carefully. But we're creating a tax-free estate. Okay? We're jumping the tax fence. We're making gifts. This guy, because the tax law is going to be cut in half in 3 years, that $12 million exemption that's going down to $6 million, he's going to give away some of that disappearing exemption. And the IRS has already said you're protected, you're grandfathered if you make a gift, and the tax law reverts to the 2017 levels. So they're going to put assets in trust for each other. They're going to be the beneficiary of the husband's going to be the grantor, wife's going to be the trustee, wife's going to be the beneficiary. And this works very well in a good marriage. Or, yeah. And we have another client who has a long-term girlfriend facing estate taxes, and actually our number one recommendation was to get married, because spouses can have unlimited transfers, but girlfriends and boyfriends can't. You can only give your girlfriend $16,000. You can give your wife unlimited.
What about domestic partners versus married couples?
No, married.
research on it, and it said like you have some inheritance rights. So you're saying domestic partners are not considered eligible?
No, maybe you're talking common law marriage, but it's for married couples, husband and wife, legal marriages.
Question. How does that differ from like a family trust?
Family trust created while you're alive or at death.
While alive.
Well, it could be exactly one, but are you want to make sure that you're the beneficiary of it.
Okay.
But the point is, you set up a trust for your wife sets up a trust for you. Each of you are the beneficiaries of the other spouse's trust. You're the trustee. You make all of the decisions. You decide what to buy, what to sell. And at your death, it all passes tax-free down to the kids and the grandkids. Now, again, not everybody needs this. If your net worth isn't going to be over the exemption amount, which is $6 million in 3 years, you don't need to do this stuff. Okay? But like Parker said, you should think about this stuff before you become high net worth, or Stuart said that actually, because people that scramble at the end, they're restricted on how much tax planning you can do.
So does it matter what social, did you use EIN number or social security number? Does it matter who it is?
It's an irrevocable trust, so you need an EIN.
So you could take its own.
Yeah. And this has what's called generation skipping provisions, because in Virginia, once you put assets in an irrevocable trust, it's never ever taxed again for multiple generations. It's what the Rockefellers, the Kennedys did over the years. Keep the assets in trust, just be the beneficiary. Enjoy the income, have access to the principal, have a friendly trustee. Okay.
I have a question. How come, like, you don't put every property into an irrevocable trust?
Because they may not be high net worth and face estate taxes. If this is an estate tax move, what are you doing up here?
I'm ready to talk about charity and how they're gonna,
Well, hang on one second.
how they're going to be the big winner of tax law
Oh, okay.
change.
I'm
Did
sorry.
I hear what you said? You said an irrevocable trust does not get hit with inheritance taxes ever in the future?
Yes.
So if you take,
If it's structured properly.
so I guess what I'm hearing is somebody's got a bunch of money, they invested in an investment vehicle, and it starts kicking off enough money that it's perpetually where it's at, but it's kicking off millions of dollars every year. And that millions of dollars every year going to all these great grandkids,
Well, that's
they're not paying
that's
taxes on
that's
that?
income tax. That's different from death tax. The asset in the trust, when it passes to the next beneficiary, is estate tax free, but the income coming out is still subject to income tax.
Okay.
Let me see if I can spend a moment on that. So the estate taxes are going to be the most heinous ones, where it's at 40% and it's due immediately. You guys might be thinking about capital gains tax as well. That's about 20% at the most. So I'd rather avoid the 40% tax than the 20% tax. But the income pushed off these trusts, it is declared as taxable income.
Okay.
So anywhere from 0 up to 37.x%. Or it could be reinvested in the trust and not declared. But one note I did want to say about the SLAT before we move on, it's what's called a grantor trust. So if dad moves assets into his SLAT, a grantor trust means that the tax ramifications fall back onto the grantor. So again, when we talk about the different taxes, your estate tax at 40%, capital gains down at 20%, your income tax might be a little bit lower than that. Those are the taxes that we're looking at, and we're trying to push those back to my dad to keep them at low personal rates.
So why would anybody not do a SLAT trust in the beginning?
Because you're not high net worth.
Well, the assumption is that you certainly will be. You don't know.
But
It's just upsetting.
I don't want to give away too many assets. I don't want to put all of our eggs in one basket and say, so dad has 4 rental properties. I don't want all 4 rental properties to go 2 and 2 in slats, because if something happens, if there's a premature passing, I don't want my mom to be living off the income of 2 and not 4 properties. So some assets go in there, some stay in the estate, some go in different types of trust vehicles. So we have multiple plans going on. Again, goes back to the modeling, where if something happens, I don't want him to run out of income, and then I had to gift back to him.
And something else that I'm
He loves your
hearing,
dad, yeah.
the other thing that I'm
That's-
hearing from you guys is high net worth today and high net worth in 3 years. High net worth in 3 years is half of what it is today.
Yes, exactly.
Okay. That's kind of key.
Dave, can I use you for this next example since you go to Williamsburg Community Chapel?
Sure.
Great. So we're going to talk about avoiding capital gains tax. This is not a 1031, and this is not an opportunity zone. This is for someone who is at least a little bit charitably inclined. This is for someone who's hopefully a little bit older and in a higher tax bracket. Pausing and I you didn't get older. Was it the older or the tax bracket that didn't stick? This is somebody who's selling an asset. This does not just apply to real estate. I had mentioned how we have a doctor client who bought QQQ, which is an ETF with all the high tech growth companies. He bought that in 2001 for this, and even where it is now after the market correction, he's getting ready to retire. So he wants to take a growth asset and turn it into an income producing asset while avoiding taxes. So selling an asset, charitably inclined, families with or without children, perhaps they're already getting enough inheritance through other means, or perhaps there are no heirs. We had mentioned one of our clients who's a home builder. They don't have kids. They don't have any heirs. So this is a prime vehicle for them. If dad sells a rental property, there's likely capital gains tax exposure and depreciation recapture exposure as well. So we want to avoid those. Scott, if you could. Deal. All right. Pretend Dr. Don sells QQQ and fair market value would be $1 million, but he bought it 20 years ago where he paid $100,000 for it. He has tax exposure on roughly $900,000 worth of gains. 20% capital gains tax, and then of course the state of Virginia gets you with another 5%. So his actual net proceeds go from $1 million down to just under $800,000. The planning we're trying to talk to you all about today is figuring out how to make sure the IRS is not the beneficiary, whether that's estate taxes, income tax, capital gains tax. We, of course, love them, but we don't want to pay them a dime more than we have to.
Well, they're going to hire 87,000 agents, so somebody's got to.
Need some money.
All right, Dave, I'm going to use you for this example, and I apologize if my back's to y'all as I speak. Pretend Dave gifts one of his rental properties to a charitable trust that is already set up. So Dave has created a charitable remainder or a charitable lead trust. We're going to use a remainder for this example. Dave says, I want to sell a rental property, low cost basis, high tax exposure. We're first going to retitle it to this trust vehicle. That's the first thing he does. So $1 million goes into the charitable trust, and we're going to say that's for the benefit of Williamsburg Community Chapel. Then once it's in the trust, the trustee, whether that's Dave or the church, sells the property. Charities do not pay capital gains tax. So your net proceeds go from $780,000 to $1 million. So number one, we've avoided capital gains tax of $220,000 or so. So there is a net $1 million inside that trust. Now we'll talk about inside the trust. Dave can buy more rental properties. He can buy investments. He can hold cash. He can do whatever he wants to do in the trust. He's controlling it. Whatever assets he wants to put in there is up to him. We'll talk about number 2 and 3.
Can I ask you a question? So in that example, not to keep singling out Dave, he transferred that's $1 million to the community chapel, right?
It's in a trust for the benefit, so it's not to the church, but it's ultimately going to go to the church
At
at him or his wife's passing.
So what I was gonna ask was, if that $1 million goes to the church, and then they just agree to transfer it back to him, not that church would probably do this.
It would violate tax law.
Okay.
So number 2, we're going to talk about a lifetime income. Dave's had his 40 years in the Coast Guard. He's ready to put his feet up. He's ready to retire. He is able to draw a lifetime income from that CRT. We're just assuming it's 6%. It can be anywhere from 3% up to 12% per year. So call that $60,000 that is going to be spinned off to Dave in an annual income. Now, I had mentioned QQQ as an investment. Their dividend ratio, I think, was 1.12%. So not really an income producing asset, but our doctor wants to retire and he has a huge tax exposure. So we're trying to figure out how to take a growth asset or a low basis asset and convert it into the income that Dave needs to supplement his retirement.
Or a piece of raw land.
Raw land. Number 2 and number 3 work in tandem. If you pull the lever down on one, the lever goes up on the other one. If you take a huge income tax deduction, you might have a lower income because Dave's in a 40% tax bracket because the Coast Guard pays extremely well. He may want more tax deduction than the income. So he says, I'm in a low tax bracket. I don't need as much of a deduction. I'm going to take the higher income and suck more of the principal out of there that he can. We assumed Sally, being a 62-year-old female at a 30% tax bracket, her tax deduction was about $250,000. So the IRS owes her a check for $90,000 in tax savings. That $250,000 can be used over a 5-year period. It doesn't have to be used all in 2022, but over the next 5 years, it can be applied against income, or Dave can say, I've got a large 401k, let's convert it to a Roth and avoid the RMDs. But there's a pretty moderate income tax deduction. Again, this is middle of the road with the 6% and a decent tax deduction.
So during this 5 years, you can look at the tax brackets, figure out whether you went less or more in that particular year to maximize your benefit.
Dave would make the decision up front if he wants more income or less deduction, less income or more deduction, and whatever deduction he has is used over a 5-year period.
Okay, so it's fixed.
Correct. Correct.
Can Dave start his own charity and he put his money into that charity?
If you hire a really good lawyer and CPA who will sign off for it, sure.
Well, yes, you can set up a family foundation, as you can see on the slide here, but you get less of an income tax deduction rather than using a public charity like the church or the Christopher Newport or Cancer Society.
Now, the fourth point is a third tax we're going to avoid here, and that's estate taxes. We've assumed that Dave has worked hard, built a great portfolio. He's subject to the estate tax change that's happening in 3 years. Because these assets are not in Dave's estate, he doesn't directly control them. He does not owe the 40, well, we had ran a smaller number than the 40%, but those assets are not subject to estate taxes. So Dave has avoided income tax, $250,000 income tax deduction to be used over 5 years. He has avoided capital gains tax on the sale of his real estate. Now he has avoided estate taxes. I don't want to get too stuck in the weeds for the CRTs, but the rule in IRS code is as long as 10% of that $1 million goes to charity, this is kosher.
So, and the other piece, so a gift of property, I sell the property within the trust. I'm not subject to any of like the 1031 timelines or
Correct.
anything like that, right?
You are not subject. Free reign.
So you could build a portfolio within that trust and continue to do that all tax-free without having to do 1031s.
Correct. But knowing that after you and your wife's passing, it's going to charity. So, but only 10% of that has to go to church. You've just avoided 90 grand in taxes today, and only 100 grand has to go to charity.
So what happens
30 years
after-
down.
It's a Dave does pass, God bless his soul. But only 10% goes to the charity. What happens to the other 90%?
You've sucked all that back out via income. If you've lived, yes, if you die next year, God bless your soul. Charity was probably a big winner, but hopefully your wife is going to be around for the next 30 years. But the idea is that you suck all that back out.
So is there a limitation to how many charitable trusts you can do?
No.
So you can continue to perpetually do more as you.
You could, but
Because you're sitting the tax.
Can you use it in the one trust or multiple times?
you would probably want to do multiple trusts so you could have some as a higher income, some as lower tax brackets. You can't have multiple, but again, this is what goes back to the modeling that, yes, it sounds like a great idea, but until we know what's going to happen 20 years down the road, I don't want to make those irrevocable decisions. Now, you can go to Christopher Newport and use the trust that they use there. We're familiar with working with CNU. But they're going to say what the provisions are, what the income is, who's the trustee, when it goes. Or you can create your own trust that says if President Tribble, or I guess now Adelia Thompson, does something to make you angry, then you change it to Hampton University, or you can create your own document that has your own provisions.
I'm wondering about family offices. Is this what a part of what family offices do? They set up their own charitable trusts?
Yes, absolutely.
Just because of what you just mentioned, only 10% really needs to go to the charity.
Correct.
And
Well-
family offices are kind of set up to continue to build wealth across generations.
Yep. There are other types, and again, we're going to wrap up on the CRTs, but there are other ones that pay the income to charity and then they come back to the kids.
Yeah.
And obviously you wouldn't want just 10% to go to your kids. You can do the inverse of that. But some people say, well, what about my kids? What about my kids? You're giving it all to CNU.
I don't
Dad.
say that.
We're able to create a wealth replacement trust. It's another irrevocable trust where making sure that some of those proceeds come back to the family. If we go to the next slide, I'll explain it. So we're working through the economics. Without the charitable trust, you pay capital gains tax and estate taxes. With it, those two taxes are avoided. So the net to family without the trust is around 500. We assume that the wealth replacement trust was put in with a $500,000 insurance policy. So that would go net to family tax free. But charity is the big winner because you see they go from 0 to $1 million. I mean, obviously you would want to pull more off of there, and maybe you want to leave $1 million, maybe you only want to leave 100,000. Depends how you structure it. But the other big winner would be Dave, who had the advancement of all that tax deduction. See, if Dave left this asset to charity, bequeathing it through his will, trust, or beneficiary, he didn't get any lifetime tax benefits from there. He got that at his passing. So he avoided capital gains. Well, you avoid that through step up and basis, but he avoided estate tax. He didn't get any income benefits of it today. And then the annual income, like I was thinking, that very small dividend, but now it's being converted to a 6% income. These charitable trusts are the exact thesis of what I was talking about for our motto. If we don't have all of our clients' advisors sitting around the same table coordinating, things slip through the cracks. As you can see, there's a legal perspective, trust. There's a CPA perspective, tax. There's a financial planner perspective, financial modeling and investing the proceeds in there. The best planning is a result of coordination and everybody sitting around the table and saying, how can we make sure Dave doesn't pay a lot in taxes? Did I miss anything for the CRTs?
No.
Okay.
Guess I'm ready to retire. Can we have the next slide? Anyway, the charitable trusts are just another tool that you now know about that you can keep in your back pocket and just not be obligated to do a 1031. You're done.
If you are a real estate agent and you say, oh my gosh, I'm listing a property how can we retroactively do this? Unless you have a really good lawyer, the IRS could technically see through that. So your charitable trust would need to be set up before any marketing of the property is done in order for it to be above board.
Yeah,
So something that needs to be proactively thought about.
right. Yeah, you don't want to do a charitable trust when you're at the settlement table, because they'll say you didn't do this because you were charitable. All right, so let's say you own a real estate portfolio. Maybe any of you have partners. All right, so your partners might have kids, you have kids, and you start thinking, well, how's all this going to pass down to the kids, and how is everybody going to get along well? Because my partner and I get along very well, but how will our kids get along, particularly if some of them aren't even interested in real estate, right? So I have 2 kids. Parker's obviously interested in it. My other son isn't interested in it. How are they going to all work together on this? Well, Friendly Restaurant, you probably heard of Friendly's. They went through bankruptcy 2 times, but it was started by 2 brothers out of Massachusetts back in the Great Depression. And I think they were up to 400 restaurants at their peak, but they had a lot of infighting, family conflicts about the direction of the business. So next slide. A lot of times when you're in partnership with somebody, you need what's called a buy-sell agreement. The buy-sell agreement says what happens if you die, become disabled, you disagree, one of you gets a divorce, or one of you wants out. And it sets a price, and it sets the terms for the payments, usually a promissory note paid out over 10 years. So let's say we have brother and sister who have a real estate portfolio. And they realize that all of our kids aren't going to work well together with this, and I don't want to be in business with my sister-in-law, for instance. You know, let's say she says, I don't want to be in business with the widow because she doesn't understand real estate and she's not a business person, or I don't want to be sexist. It could apply either way. So we have a buy-sell agreement, and it says if brother dies, sister buys him out, pays off the widow, and it's done. But the problem is what if you have a buy-sell? You can hit the next slide. And some of your kids go to college, graduate, and later enter the business and want to participate in the business. If you sign a buy-sell agreement and then your family matures and grows professionally, you may disinherit your kids if there's a buy-sell agreement, right? If you have a buy-sell and it says you must sell, must buy at death, then Parker, for instance, would be squeezed out. I had 2 other partners at one time, and none of us wanted our kids in the business. So, but if you do want your kids in the business, or some of your kids want to be in the business, you really have to decide, how do you treat active and inactive children? Because you can't say active kids and inactive kids should be treated equally if only one of them does work. You can't expect the active child to do 100% of the work and share 50% of the profit. Okay? So you can have a provision where you do a wait and see, where you pass your stock into a voting trust, and the voting trust determines which kids are going to be in the business. They get the real estate. Which kids aren't going to be in the business, maybe they get cash or the IRA or other assets. So the moral of the story is, I don't think mixing active and inactive kids in a family business is a good long-term solution. Because one works hard, one likes real estate, one moved to Cleveland, Ohio, and just expects you to send rental checks on a monthly basis. So have a plan so that your kids are not arguing over all the real estate. Okay. Now this section is where the lawyer would normally speak, but I feel I can pull it off. I didn't go to law school, but I've made a career out of this. So asset protection. The first thing you need to know, a term is called fraudulent conveyance. You cannot begin asset protection planning if you've got a notice nailed to your door saying, please appear in court. It's late. The judge would overturn any transfers as a fraudulent conveyance. So you got to start early. You got to start when you don't need it. Okay? And it must be for non-asset protection purposes. Well, a lot of this stuff is good estate planning, and that's what you'd say. Well, I was doing estate planning. I needed a trust. I needed an LLC. Do it early. Asset titling. Certain assets are protected by titling. Joint tenancy with right of survivorship offers no asset protection. Tenants in common offers no asset protection. But if you title assets jointly with your spouse as tenants by the entirety, and only one of you signs for the loan, and we had a lender here, so she probably knows that you have to get both spouses to sign. But if it's tenants by the entirety, and one of you is sued for a car accident, or you had to declare financial problems, the other spouse is protected. So tenants by the entirety is the only type of titling that gives you the slightest bit of asset protection. Most banks are smart enough, they want the husband and the wife to sign for the promissory note. A lot of people say, well, why don't I just put my kids on the deed and we'll avoid probate and it'll be protected. Well, that's a bad idea, because if Parker had a car accident or got a divorce and he owns property with me, they would then start attaching my assets to satisfy his judgment claims. Now in Virginia, there are exempt assets, exempt from bankruptcy proceedings. 401ks, 403bs, ERISA plans. These are qualified retirement plans, thrift savings plans. Any money you have in a retirement plan is bankruptcy proof. Now I know we're in a room where everybody here loves real estate, and you maybe you don't feel that mutual funds are a good idea. But we have some real estate clients that have put rental properties in their Roth IRAs. Any of you doing that? Well, that's an alternative to mutual funds. And you can do that, and you can buy and sell your assets without any income tax. IRAs in Virginia, if you had up to $1 million in IRAs, that's bankruptcy proof too. If you're in real estate, my experience has been, it's not if, it's when you're going to have creditor issues. You know, if you're leveraged up, you're doing mini subdivisions, and the economy turns. I've just seen it over the years through different economic cycles. So these are exempt assets.
So when you say they're bankruptcy proof, but they're not liability proof.
Yes.
So you put a rental property in one of in your 401k or solo 401k, it can still be attached in a suit, right?
No, because whatever you put in your IRA or your single K is creditor proof. Now, if the tenant of that property sues you, just because you own that property in a single K doesn't mean he can't attach you personally.
Okay.
But if you have retirement accounts, they're exempt from personal creditor proceedings.
And I think you'd have to be very careful as far as making sure not to pierce the veil, as far as making sure that there's nothing using it as a personal asset.
Well, piercing the corporate veil is what I think you're referring to is, are you really a business separate from your personal? And we're going to talk about that in a minute. Yes, sir.
So self-directed RE, right? You're talking about real estate in your self-directed.
Yes. Yes.
Or solo 401k. You can do that.
Single Ks, they're great. Single Roth 401ks, you can put $27,000 in a year. You can use your charitable tax deductions to convert your IRA to Roth. If you have money in your kids' 529 plans, that's bankruptcy proof. If you have life insurance, cash value, and death benefit, that's creditor proof. And same with the annuities. Everything else is available in a judgment proceeding. If you have insufficient insurance to cover for any liability, car accident, or if you have insufficient assets in a bankruptcy proceeding. Next slide. All right, so a lot of you know that you need to create an entity to separate your personal assets from your business assets so that they don't pierce the corporate veil. And sole proprietorships have no protection. And so many of you own real estate in your personal name. Maybe you own it jointly with your spouse. No protection. Okay? You have a tenant problem, they're going to attach your personal assets if you didn't have enough liability insurance. Partnerships are even worse because if I'm in a partnership with this gentleman and I screw up, he's responsible for my debts. Right? So we're not going in business together. So partnerships are actually worse because I trust my wife. You may not trust me as much. You have a good reason to trust me, though. No problems or anything.
Next bullet point.
Corporations, S Corp or C Corp, subchapter S corporations are perfect for real estate, except that you have to, there's a lot of filings you have to do for that. Limited liability company, most of you are familiar with that, right? Okay, perfect. Single member LLC or multi-member LLC. Multi-member LLC is more complicated, more filings, separate tax returns, but it's acting more like a separate business than a single member LLC. I do believe a single member LLC gives you plenty of creditor protection though, and it keeps your tax return simple. Now, business trust. LLCs, if you're doing it the right way, you would have one LLC for every rental property you have. But that gets expensive with annual fees. A business trust avoids the need to have a series of LLCs where you have the annual fees. You may have even heard of land trusts where you can shield the nature of the buyer and then the trustee resigns and you become the trustee of your own land trust. That land trusts have no asset protection. And in Virginia, there is a domestic asset protection trust. Most of you don't need this. It's a trust you can put assets in that you can be the beneficiary of. You don't have to count on your spouse to take good care of you. But Virginia is one of 16 states that let you create a trust in advance. You put assets in, and they're exempt from bankruptcy proceeding, and you can be the beneficiary of it. Next slide. Any questions on that last section?
So when you reckon a primary property that spouse is actually put it into a LLC or domestic or a business trust?
So you're saying, should you put your primary residence in an LLC? There's no business. An LLC has to have a business purpose to be created, and putting a primary residence that isn't income producing isn't a valid business purpose.
Even if you have your own
You can put it in a trust.
residence. Even if you have your own office in the residence,
Are you paying rent to yourself for your home office?
well.
But no, I do not put primary residences in LLCs. No reason to. Who's going to sue you? People could walk by and slip on ice, maybe, but you have an umbrella policy and you have some good liability insurance. Rental property, certainly yes. Last topic we're going to talk about, it's called minority interest discounts. If you own 51% of an asset, your 51% is worth a heck of a lot more than my 49%, right? Because you make all the decisions, you decide income, you distribute the money, you're in charge. That's called a majority, and we're talking about a minority interest discount. And the IRS lets you discount the value of your asset for tax purposes, particularly estate taxes, if you don't have control. So let's say, again, you're a high net worth person. You got $15 million worth of real estate. It's shocking how many people haven't created an entity, but step number one is to put it into an LLC. And you might say, well, my spouse and I will each own 50% of this property, and they both could be the managing members of the LLC. We can also create non-managing members of an LLC and make gifts of LLC to the kids, like we talked about earlier, because non-managing membership, they don't have control or vote. Next slide. So for estate tax purposes, Mr. and Mrs. own 50% of the real estate portfolio, but they're going to give very small gifts to each of their children. They had 3 daughters. They're going to give 1.5% of the LLC. And by the way, transferring LLC is a heck of a lot easier than going down to the courthouse every year, retitling the deed to reflect new owners and having to re-record it. So transferability of LLCs is so much easier for gifting and estate purposes. But they've given each of their daughters, Lisa, Leslie, and Lucy, gifts. They used their $16,000 a year. But because it went over that, they had to file a gift tax return for $129,000. So they gave away $225,000 in gifts. Next slide. But at the death of Mr. and Mrs., each of them only owns 49.25%. So they're not a majority, they don't have majority control. So the IRS lets you discount the value of that asset by about 30% when you file the estate tax return. Okay. Again, this is not necessary for everybody, but the bottom line is that you take a $15 million asset for tax purposes, the IRS values it at $10 million. At a 40% tax, the savings is $1.7 million because you've compressed the value. Again, not for everybody, but the concept of discounting for estate tax purposes is what we have. Next slide. So with that, that's it. I think we're out of time anyway, right? If any of you are interested in talking or have questions and you want to fill out a sheet and let us know, we're happy to do a Zoom call with you. We have an office in Town Center in Thimble Shoals. We're happy to talk to you for 50 minutes without any obligation. Parker and I would be happy to answer any questions you have, but thank you for coming out, and thank you for hosting us.
Anybody got any questions?
A lot.
Yeah, I know. I tell you what, as I was listening, I was sitting there thinking, I need to go back and watch it again. It's one of those things where there was a lot of information, yeah, and I'm not even sure. There were some in there where I think, there's just a lot of places where it applies. And let me ask you this. We were talking about trusts earlier. Now, I